You've probably heard this advice 1,000 times. Put your money in a high-yield savings account. It's safe. It earns interest. It's smarter than letting your cash just sit there. And honestly, a couple of years ago, that advice was fire. Like, genuinely good advice. But here's the thing nobody is talking about right now. And I mean nobody in your group chat, nobody at Thanksgiving dinner, probably not even your financial advisor. The game has quietly changed. And if you're still parking your money in a high-yield savings account thinking you're winning, you might actually be falling behind. Not because you're dumb, not because you made a bad call, but because the rules shifted and most people didn't get the memo. So today, we're getting into it. Why high-yield savings accounts aren't the move they used to be, what's actually happening to your money right now, and what smart people are doing instead. Let's go. It's 2023. You're scrolling through your phone, you see some finance content, and somebody says, "Yo, move your money out of your regular bank account. Put it in a high-yield savings account. You can earn like 4, 5, even 6% interest right now." And you think, wait, 6%? My regular savings account is giving me 0.01%. That's basically zero. That's an insult. So you move your money over. You feel smart. You feel like you finally cracked the code. And look, you were smart. That move made sense. Interest rates were high, and those accounts were actually delivering real returns. People were making hundreds, sometimes thousands of dollars a year just by letting money sit. No stress, no risk, no stock market drama. So naturally, a ton of people did it. And now those same people are still sitting in those accounts, still feeling good about it, not realizing that the situation has dramatically changed underneath them. Here's the psychological trap at play. There's this thing in behavioral economics called the set it and forget it bias. Once we make a financial decision that felt smart, our brain kind of files it away under handled. We stop questioning it. We stop looking at whether it still makes sense. We just assume it's still working. It's the same reason people keep paying for subscriptions they forgot about, or stay with the same insurance company for 10 years without ever checking if there's a better deal. Once the brain labels something as the smart move, it stops reevaluating. And that's exactly what's happening with high-yield savings accounts right now. All right, let's break down what's actually going on. High-yield savings accounts, let's call them HYSAs, work like this. Banks and online financial institutions offer you a higher interest rate than a regular savings account in exchange for parking your money with them. They use your deposits to make loans and investments, and they share a tiny slice of that profit with you as interest. The interest rate they offer you isn't random. It's deeply connected to something called the federal funds rate, which is basically the interest rate that the Federal Reserve sets for banks borrowing money from each other. When the Fed raises rates, like they did aggressively between 2022 and 2023, HYSAs get juicy. Rates shoot up. That's when people were seeing 5 and 6% yields. But when the Fed cuts rates, which they started doing in late 2024, those HYSA rates start sliding back down. And that's exactly what happened. Banks don't advertise this loudly. They're not going to send you a push notification that says, "Hey, your interest rate just dropped again." They just quietly adjust the number, and most people never notice. So let's say your HYSA was giving you 5% back in 2023. Today, many of those same accounts are sitting closer to 3.5%, maybe 4% at best. And some of the accounts people originally signed up for, especially at bigger, more traditional banks, are even lower than that. Now, 3.5% sounds decent, right? It's still better than zero. Let me introduce you to a concept that doesn't get nearly enough airtime. Real returns versus nominal returns. Your nominal return is the number your bank shows you. Let's say it's 4%. Your real return is what you actually earn after you account for inflation. Inflation is basically the rate at which prices in the economy are rising. If inflation is running at 3.5% and your savings account is earning 4%, your real gain is only about 0.5%. You're barely moving forward. And here's the thing about inflation, it's sneaky. You don't feel it in one dramatic moment. You feel it slowly. Groceries cost a little more. Your rent goes up. That streaming service raised its price again. Over time, the purchasing power of your money quietly erodes. So when people say, "I'm earning 4% in my HYSA," what they don't always consider is, asterisk 4% compared to what? Think of it like this. Imagine you're on a treadmill. The treadmill is moving at 3.5 miles per hour. That's inflation. If you walk at 4 miles per hour, You're technically moving forward, but barely. You're not really going anywhere fast. You're just keeping up. And in some periods, if inflation spikes and your HYSA rate stays flat, the treadmill is moving faster than you are. You're walking backwards and you don't even realize it. Now here's the second thing most people aren't thinking about. Taxes. The interest you earn in a high-yield savings account, that's taxable income. Every year, at tax time, you owe taxes on whatever interest you made. So if you earned, let's say, $1,000 in HYSA interest and you're in the 22% federal tax bracket, you're handing about $220 of that back to Uncle Sam. Suddenly, your real after-tax, after-inflation return is looking a lot less impressive. This is what financial folks mean when they talk about tax drag, the way taxes slowly eat into your returns without you feeling it all at once. It's subtle, but over time it's significant. Compare that to something like a Roth IRA, where your money grows completely tax-free, or a 401k, where your contributions reduce your taxable income right now. These accounts are designed specifically to help you keep more of what you earn. High-yield savings accounts. No such protection. Okay, here's where I want to get into the deeper stuff. The psychological layer. Why do high-yield savings accounts feel so good, even when the math doesn't fully support them? 3 words: the illusion of safety. There's a powerful psychological principle called loss aversion. Research in behavioral economics, famously studied by Daniel Kahneman, shows that the pain of losing something feels about twice as intense as the pleasure of gaining the same amount. In other words, losing $500 feels way worse than winning $500 feels good. And because of this, a lot of people anchor their financial decisions around not losing rather than actually growing. The stock market can drop. Investments can go down. But a savings account? The number never goes backward. It just slowly ticks up, month after month. That feeling of safety is genuinely valuable for your mental health. But it can also trick you into thinking you're building wealth when you're really just preserving it, and sometimes not even fully doing that, thanks to inflation. Here's the deeper insight. There's a difference between financial safety and financial progress. A high-yield savings account is a tool for financial safety. It's great for your emergency fund. It's great for money you're going to need in the next 6 months to a year. It's great for short-term goals. But a lot of people, and I see this constantly, treat their HYSA like it's an investment strategy. They pile money in there, watch the number grow, and feel like they're building wealth. The truth is, wealth building requires you to take on some risk. Not reckless risk, intelligent risk. The kind that compounds over time and genuinely outpaces inflation, taxes, and everything else working against your money. The stock market, historically, has returned an average of about 10% annually over long periods. Real estate has built generational wealth for families. Even I-bonds, during periods of high inflation, have crushed what most HYSAs can offer. Your HYSA? It's a parking spot, not a destination. When a bank advertises a 5% HYSA, that 5% is the headline. It's the number your brain latches onto. But the fine print? The actual effective yield after fees, after rate adjustments, after taxes? That number is quieter, less exciting, less memorable. Our brains are wired to remember bold, simple numbers. Marketing people know this. That's why they put the big APY number in the ad and the asterisks in the footnotes. When you're making financial decisions, you have to train yourself to ask, okay, but what's the real number? What do I actually keep at the end of the year? That mental habit, drilling past the headline to the real figure, is one of the most powerful shifts you can make as someone who wants to build real wealth. So what should you actually do with this information? Let's keep it simple and practical. First, keep your emergency fund in a HYSA. Full stop. Asterisk asterisk. 3 to 6 months of living expenses, sitting somewhere safe, liquid, and earning something while it waits. That's exactly what a high-yield savings account is designed for. Don't overthink it. Don't try to invest your emergency fund. That money needs to be boring and accessible. Second, stop treating your HYSA like an investment account. If you have money sitting in a high-yield savings account that you don't plan to touch for 2, 3, 5, or more years, that money is probably not working as hard as it could be. You're paying an invisible tax every year in the form of inflation and actual taxes, and you're missing out on the compounding growth that long-term investments can provide. Third, start thinking in terms of time horizons. Money you need in the next 6 to 12 months? Savings account. Safe, accessible, done. Money you won't touch for 1 to 5 years? Consider I-bonds, treasury bills, or short-term bond funds. These often offer competitive rates with similar or better tax treatment. Money you won't touch for 5+ years? This belongs in the market. Index funds, ETFs, a Roth IRA, a 401k. Let compounding do its thing over time. Fourth, check your actual rate right now. I'm serious. Pull up whatever HYSA you have and look at the current APY. Because if you opened it back in 2022 or 2023 when rates were sky high, and you haven't looked since, there's a real chance that rate has dropped significantly and you just didn't notice. Knowledge is leverage. Know what you're earning. Fifth, automate and diversify. The highest earning people I've seen aren't necessarily the ones making the most money. They're the ones who built simple, automatic systems. Auto deposit into their investment accounts every month. Auto contributions to their retirement plans. They set it up once and let time do the heavy lifting. You don't have to be perfect. You just have to be consistent and intentional. Let me leave you with this. There's a reason most people never build serious wealth, and it's not because they didn't earn enough money. It's because they kept doing what felt right without stopping to ask if it still was right. High-yield savings accounts felt right in 2023. For a season, they were right. But the financial world doesn't stay still. Rates change. Inflation shifts. New tools emerge. And the people who stay ahead are the ones who keep learning, keep questioning, and keep adjusting. Your money deserves a strategy, not just a parking spot. The goal was never just to save money. The goal is to build a life where money works for you, quietly, consistently, in the background, while you focus on everything else that matters. So take a look at where your money is sitting right now. Ask yourself, is it safe? Is it growing? Is it being taxed in a way I could avoid? And is it aligned with how far away my goals actually are? Because the people who ask those questions and actually make moves based on the answers are the ones who look up 10 years from now and can't believe how far they've come. All right, that's a wrap for today. If this hit different, share it with someone who still thinks their HYSA is doing all the heavy lifting. And if you want to go deeper on where to actually put your money depending on your timeline, drop that in the comments, because we are absolutely making that video next. See you there.